Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Cut to the Chase. Now today I wanted to talk about the sell-off in China and Hong Kong equities, which approached eye-watering levels yesterday. Many of you will already know the numbers. Since March 8th close, MSCI China has fallen over 16% and the Hang Seng has fallen over 11%, both led by even larger declines in US-listed Chinese stocks. For the Shanghai Composite, Tuesday's drop was the largest one-day decline since February 2020. Now what's causing this? It's not just one thing alone, which is why we're calling it a bit of a perfect storm. The initial trigger came last week after the US Securities and Exchange Commission, or SEC, identified several Chinese ADR listings as failing to comply with the Holding Foreign Companies Accountable Act. This law permits the SEC to ban companies from trading on US exchanges if regulators are not able to review company audits for 3 consecutive years. A second factor was China's decision to impose varying degrees of lockdown across several major cities, including Shenzhen and Shanghai, following what is a significant COVID outbreak. This caused markets to worry about just how much of a drag these measures will impose on economic growth. A third factor was worries, of course, that US sanctions could extend to China. This in turn followed media reports that Russia had requested Chinese assistance in Ukraine. Now, it's often difficult to predict market moves over very short horizons when sentiment is so one-sided, but we think 4 signposts can help guide us on where markets go from here in the coming days. The first signpost to watch is the path of China's COVID cases. This should offer greater clarity on the likely length and intensity of lockdowns and therefore their likely economic implications. Other countries' experience, though, suggests that any easing of lockdowns is unlikely to be very quick. The second signpost is China's monetary and fiscal policy reaction. Both have turned more supportive in recent months amid a policy goal to stabilize growth, but markets are unlikely to be quite sensitive to the magnitude of any new measures. The third signpost is geopolitics. Falling oil prices is a positive as it alleviates one pressure point. However, markets are likely to very closely watch whether recent US public statements urging China to avoid tacitly supporting Russia remains contained to media reports alone, or if it ends up actually worsening relations between the two countries. The fourth signpost, of course, to watch is equity market technicals. Now, for the Hang Seng, we see technical support at the 2016 low of around 18,279. Deeply oversold conditions do raise the odds of a sharp rebound in the near term. Just as an example, one chart that came across my desk this morning illustrated that the RSI, which is one measure of oversold conditions, has fallen to a level we last saw all the way back in 1987. However, for the downward pressures to ease in a more meaningful manner, though, we need the Hang Seng to break above key resistance at around 21,115. So a number of things to watch in China markets over the coming days. But having said that, we would not take our eyes off the other key event, which is the Fed meeting, which concludes tonight. Recall that the most important thing we and the market will be watching closely is any signaling of how policymakers are thinking about the path of interest rates over the rest of this year. So a lot to watch, but we'll take a pause there. If you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening. We wish you a happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.